So last episode, I said ARR doesn't matter, and it was about retention. It's about the quality of growth. It is true. Retention matters above all else, but ARR does matter. Now, when I was a founder, I was chasing ARR just like you. ARR is a critical metric, probably the number one metric that you're going to be judged by. So, am I contradicting myself? Well, I'm going to give you two reasons why ARR matters. When you raise money from VCs, you're making a specific deal. You have a crazy idea that's going to change the world. In your business idea, you have these huge aspirations. Founders like you and me, we dream big, but you need someone to help you. And so you find a special type of investor called a venture capitalist who's going to partner with you with your big vision. Now, VCs in general, we're high-risk investors. We swing for the fences, right? We have a return that we're aiming for. We commit capital that comes from our limited partners, and that's usually a large institution like a pension fund, and we give you their money, and you return that at some liquidity event. The returns are not arbitrary. Venture returns are typically 15 to 25% per year. Now think about your average savings account. Like right now on the online banks, it's like 4%. Public equities, if you invest that, it's about 10% per year. Venture is much higher, but it's also higher risk. A lot of the portfolio companies we invest in as VCs, they flop. So the returns that we, the VCs, need to survive is actually driven primarily by one metric. It's the ARR of our portfolio companies. In other words, your ARR is important to the VCs, and it should be important to you because you took money from a VC. If you don't reach your ARR goal, it's going to make it a lot harder to raise future rounds. Now, the second reason why your business has to have these big ARR aspirations is because your business itself has huge aspirations. For early stage venture, that aspiration has to be a company worth $1 billion. $1 billion is necessary because given the percent ownership that a VC typically has and all of the eventual dilution, that's the size of the outcome in order for me, the VC, to stay in business. In order to get a $1 billion valuation, we're talking about a company that's throwing off at least $100 million of revenue. Now, for the fund that's investing in you, that time frame is typically a return within 5 to 7 years. So VCs have a pattern. We call it triple, double, double, double. What that means is when you hit your 2 million of revenue, your early stage revenue, that following year, we're looking to have it triple to 6 million, from 2 to 6, that's triple. And the year after that, it's going to go from 6 to 18 million. That's a triple. The double, double, double comes the following year. The 18 becomes 36. Now we understand as you grow larger and you're penetrating more into the market, your growth inevitably is going to slow. Things are just going to get harder. So you only have to grow twice as much. So from 18 to 36, the following year after that, 36 to 72 million. And now we're on our 5th year. And it goes from 72 million to call it 140 million. At that point, typically your company is valued at around $1 billion. And the VC has the ROI that we need to exit and sort of make our money. So your company ARR has to track on that trajectory. What if instead of 100 million ARR, you just like, I'm throwing off 20 million ARR? That's a lot. Why not just play it safe, take it easy? That's a lifestyle business. Well, what's a lifestyle business? It's when you have a business that's growing slowly, throwing off cash for you, the founder, and you have a good life. You're working on a project that you like, you have a great salary, you've achieved the perfect work-life balance maybe. And it's a good life for you, but you partnered with the VC investor. And the agreement and the vision we had was that you swing for the fences. So if a VC like me keeps investing in lifestyle businesses, we're not going to be around much longer. That's why there's this drive for ARR. Now, I still stand that ARR at all costs is the wrong strategy. Your retention matters because you're leaking users. And the only way ARR is going to keep on growing is if you inject more capital to drive more sales and marketing to get more users. My own startup, Muntree, we did exactly that. At that time, it was about growth at all costs. Just take over the market, first come, first serve. It's eventually going to catch up to you because as you engage more later stage investors, they're going to be skeptical that throwing more money into sales and marketing is the solution. Now, strong retention will ensure your business knows how to be capital efficient, meaning you're going to spend dollars invested in a sustainable way. And that in itself will attract investors. Now, these days, I'm not sure many investors are going to invest in a company with high ARR, but terrible retention, meaning users are basically just quitting after the first try. However, there are many investors that will invest in low ARR growth, except with amazing retention. So although retention is critical, the ARR goal is the North Star. Now, as a founder, you have to balance the two. You have to appreciate the two. It's like yin and yang. You got to just master both. So keep that in mind and swing for the fences.